OTTERS-EAR-MITT. First of all, we have the objective. What is the what do you want from this particular trading strategy? Whatever it is, 8 EMA bounce, or you could have your own thing that you've made up. What is the objective? Is it for constant mini wins over a period of time? Like, is it there for cash flow? Or is it there to catch massive runners? Because the objective of the strategy really dictates the strategy, if that makes sense. So for example, if you're doing something for constant cash flow, you're going to be realistically looking at the lower time frames and using way less risk. Or are you doing positional trades because you're really trying to swing for the hills and catch the big, multi-month swings? Again, different strategy. So once you know what that is, then what type of system is it? Because if you're doing, like, let's say a monthly cash flowing type strategy, well, that's going to definitely dictate the type of system. Like, is it going to be a ranging system where you're bouncing back and forth, i.e. like a bit of a swing trading or volatile ranging strategy? It really does depend. And also, what's the trigger? So, like, the entry to a trade isn't like, let's say you're using two moving averages crossing over. Not that we do that. It's a bit of a noob type strategy, but it seems like the whole of the internet uses some sort of moving average crossover system. But let's say that is the thing. That is not your entry. You have to define the differences between what is the trigger of your strategy and the entry of your strategy. So let's say you do have a moving average crossover system, and let's say the moving averages cross over. That's not your entry, that's your trigger. That's the thing that goes, holy shit, we need to get ready to place a trade here. You need something else for the entry. And it could, like, there's so many different things you could be doing. Like, it could be, right, we're going to jump down onto a lower time frame and we're looking for something else to confirm that the trade is one that we want to take. Now, I'm not a massive fan of over confirmation because a lot of people go over the top. They they put in like 5 confirmations. This needs to do this need and they'll load up their chart with confirmation overload. And when you have too many things that need to basically align, it's like a solar eclipse of some sort. The trade is already gone. So 1, maybe 2 confirmations, whatever you're using for confirmations, and then get in, because the move will have dissipated by the time if you have too many confirmation hurdles. And then what's the risk to reward? Like, you could have a great trigger and an entry, but if the stop loss is too loose, is it worth it? Like, is it a 1-hour trade? Then if it is a 1-hour trade, then you've got to be damn positive that it's gonna, your probability of trade success needs to be high to offset the low R multiple. And then, where is that stop? So risk to reward and stop, they go hand in hand. So that's the OTTERS part. And then the EAR-MITT bit, exit. What is the exit? And just like the entry, your exit could potentially have a trigger as well. So, it could be a case of, let's say a support, let's say you're going long and your diagonal level of support has just been breached. That may not be the exit, but it could be the trigger for you to get ready for an exit. And then it's a case that, and the actual exit could be a Kobo, let's say. So, and then the analysis. Right, once you're out of the trade, you need to analyze your trade. Even if it was a good trade, you go, right, what did I do wrong? Even if you make money and you win a trade and everything goes perfectly, you still need to do, a post-mortem and go, right, what did I do well? What did I do wrong? What can I do better next time? Etc., etc. And then risk of ruin. So what was the risk of ruin? Now, obviously, I've had to sort of shoehorn a lot of these things into this sort of, anagram, OTTERS-EAR-MITT, something to analyze it. But you should also do risk of ruin a lot sooner. Really, when you're talking about risk to reward, you should actually be playing with the risk of ruin calculator, which will go on in a sec. And then we go into the Monte Carlo stuff, implement, and then tweaks, and then trading.